Welcome back to Young Bucks. This week we're talking about the hot start for the market in 2018. We'll discuss the headlines about Amazon partnering with Berkshire Hathaway and JP Morgan Chase to bring us affordable healthcare. And of course, we've got Super Bowl picks for you. And stick around till the end of the show when Ben calls out CNBC. Thanks for joining us.
Hey everybody, welcome to What the Buck, Young Bucks Season 2, Deuce Season. Andrew Hall here, Sam Frost, what up?
What up?
Matt Krebsbach.
What up? It's been a while.
It's been a long time. Ben Nye, how's it going?
Well, thanks.
How about that Rose Bowl? Pretty epic. Last we were talking about college football. We'll talk Super Bowl here in a little bit, but we've missed a lot of sports. We'll try to catch up over the next couple weeks. We're just going to jump right in and talk about the market a little bit. It's pretty much gone straight up until today. We're recording this on Tuesday, January 30th. I had to look at the date. Market was down a little over 1%, 1.3%, something like that. But basically just sprinting up so far. We were up more than 7% through last Friday. Start with you, Ben. General thoughts on this pretty ridiculous pace.
And it's pretty incredible. I mean, through the first, 25 days, we were on pace to be up 170% in the S&P 500 for the year if it continued. And it's
we were not. The S&P 500.
The S&P 500
was, clear there to our clients.
It's just a remarkable rally to start the year, and a lot of this has to do with revisions based on this tax guidance. You know, if your earnings go up, then people will rate your stock higher as well, and that's what's happened a lot through the first month or so.
Yeah, and it just seems like kind of ongoing enthusiasm.
It feels like as soon as that calendar flipped to 2018, like everything just accelerated, you know, like 8% in 1 month or whatever it was, 7 before the 25th or the 25th of January. Is just crazy.
You know, it's interesting. Me and Andrew went to a conference in Nashville. When was that, February of 2017?
Yeah, February or March, I don't know.
February, March, first quarter of 2017. The guy there got up and spoke, and he said, you know, I'm bullish on the market. It looks like things are going well. I like what's going on, you know, with the economy, government, like everything. And he came out and he said, but this will all stop if we don't have tax reform or some sort of guarantee come Q4. And he's like, but if we do get tax reform, the market will continue to rally. It'll take off. And I just find it pretty impressive. Like, he nailed it. You know, like, we got Q4, we get the tax reform stuff coming through. It's signed, it's official. And like Krebs said, 2018 starts. The market's just taking off. And
it's kind of, you see all these, like, kind of stupid headlines about this company giving this type of employee $1,000 bonuses or $2,000 bonuses. I mean, it's almost like everybody took those like excess funds that they didn't expect having and just dumped them straight into the market. Like, that's the only thing I can figure. I mean, we've talked on here before about a high savings rate specifically among young people, but a relatively low investing rate in terms of funds going in. But I mean, retail investments are flooding in pretty high now.
Yeah, and you mentioned millennials wanting to get into the market now, and I think the tax reform thing is an easy headline to just say, oh, like, the economy is about to be spurred, I got to get in now. I just got an extra $1,000. I think you might be onto something with that one.
Availability bias, though.
Yeah. And while we're on taxes, let's just stay there. This is breaking the agenda a little bit, getting out of order. But the tax plan, I mean, Sam kind of touched on it. It's a really easy headline to see. It's something that's, kind of quick to process. I mean, Ben kind of implied this earlier. It's kind of like if you have more money in your pocket, then you got more earnings. It just kind of makes a little bit of sense there if you think of it on the most simplistic level. All of a sudden, people start to say, well, that company's making more money. Maybe I would pay a higher multiple. You start kind of anticipating this growth. So it makes sense at surface level, but at the same time, is it not a little bit too obvious of an answer? Ben, what are your thoughts?
Yeah, I mean, I would totally agree with you. And we did a 30-minute macro presentation, quick plug.
YouTube.com/Tusk Media LLC.
And what I kind of went through on that was opinion, that I think this tax proposition is simply an excuse to buy. It's not really well thought out in terms of market participants. If you look at actually the estimates of what people expect to happen to GDP growth in general, it's not really that significant in general. Wages, I think, are a much more significant aspect. And I think to use the tax bill as an excuse to buy stocks, I think, is folly. Because I think that it is something that you can easily and quickly explain a rationale, but sometimes that's not the best rationale to have.
The question is, do you think it's overhyped, right? The tax reform? I would say no. I think at the end of the day, like, it is a big deal. Like, there's a ton of money returning back to the company's pockets. I mean, and repatriation is another thing, which is a huge deal with companies with billions and billions of dollars overseas that they don't touch because they don't want to pay. They didn't want to pay as much as taxes on it. So I think there's going to be a lot more money returning to shareholders in a good portion of companies. But I think that's what January was for the most part. I think going forward, I wouldn't expect much more and say, oh, that was due to tax myself.
Yeah, I agree with you, Krebs. I don't think, the options theory would say that the tax bill was X percent priced in up until the day that it became 100% is when that it goes 100% priced in. And so I don't think it's overhyped either. I think this is just like that remaining percentage that wasn't priced into the market that's finally coming in. And, we talked, I don't know if we talked on the show, but people last year were talking about money on the sidelines, coming in, and we kind of debated what that actually means. But now with the repatriation tax and all the money coming back overseas, like, that's the literal definition of money on the sideline that is now available to be invested, whether it's into the market, into companies, go into employee pockets, whatever.
Yeah, and I think I could talk myself into circles on this. On one hand, it's, do I have a whole lot of confidence in, corporate leadership, which for, years and years and years had access to basically free money in terms of borrowing and just used it to buy back shares and kind of manipulate their own balance sheets? Do I have tons of faith that they're going to spend wisely and that they're ready to go right now? Not necessarily, but at the same time, I have a lot of faith in the American consumer to do something that might or might not be smart, and that's spend money. And I think that's going to, trickle through the economy. That's going to have an impact, and it's still hard to argue with more cash in corporations' pockets. I think that's a good thing. I'd rather it be there than in government pockets.
I mean, I agree with you, Andrew. I mean, oil is up 40% year over year almost. So, I mean, people are going to be spending more on gasoline, that's for sure. That was a bit facetious. But
boom.
The last time, I'm just going to throw out one more number and then maybe we can move on, and that's 1986.
Wow.
1986 was the last time we had
That's
a major
devastating.
significant reduction in the tax rate, and that happened late in the year. And what happened in 1987, we all know, is the market ran up significantly before having one of the biggest crashes, one of the biggest, fastest crashes in the history of developed markets. So
I do agree. Like, this, melt up, if you want to call it that, melt ups oftentimes lead to corrections, I think.
I mean, I
think Jeremy Grantham had a whole thing on that.
I think we're out of the melt up phase. We're on full-blown euphoria right now.
Full on correction.
I mean,
starting next
you
week.
go-
We just watched Ben turn bearish right before our eyes.
You go up 7.5% in a month. I mean, give me a break. I mean, you got
in a full month.
These wise guys.
You have valuations that are higher on higher earnings, which are just a function of the math because of a lower tax rate. That's not going to continue. Don't pay up for that type of earnings growth. I mean, when you have a manufactured earnings increase, you're not going to pay up for that growth. So I don't think this continues. That's my opinion.
It'll continue for a while, for a little bit. We don't know how long, but this is the first time that you turn on the TV and all the media outlets are saying oh, the market keeps running up. The market's hot. You should buy. It's the first time in I don't know, a while.
Forever.
I mean, today's that healthcare stuff and that MetLife stuff.
Yeah.
So it's take out those black swans and it's probably up again today.
I always talk about Warren Buffett's quote, and I'm going to mess it up, but he says, be greedy when others are fearful, and be fearful when others are greedy. And so right now we're seeing this transition from everyone being fearful to everyone being greedy. And
Suddenly greedy Ben is a little more tolerable.
And so, I mean, I do think that we're pushing into that territory, and we could see, some bubble type thing come up, we have a correction, but it takes a while for that to happen.
I'm just saying, I think that we might get there sooner than we might think. And for example, I saw a chart that said 5 to 15% of traditional volume is done through TD Ameritrade and E-Trade, I think it was. That spiked up last week, and it spiked up to 35%. Retail investors are clamoring in. People just got their influx of cash at the end of the year, and they're putting it into stocks. I mean, people come up to me saying, "What stocks should I buy?"
What do you say?
I say
Bitcoin.
SPXU. No,
He doesn't
don't
really
say that. But I think that you are entering dangerous territory in the markets because of this euphoria. What I think is euphoria.
So welcome to the danger zone. We're going to be here all 2018. Krebs touched on this just really briefly, but talking about just kind of the healthcare concerns. So Amazon, Berkshire Hathaway, and JP Morgan Chase have gotten their collective minds together, and they're going to solve healthcare. Three great, selfless, humble leaders of corporate America have this figured out. A couple of quotes here. Warren Buffett says, "The ballooning cost of healthcare act as a hungry tapeworm on the American economy." So a nice holier-than-thou perspective from Uncle Warren. Keep going here. Jeff Bezos says, "The healthcare system is complex, but don't worry. We enter this challenge open-eyed about the degree of difficulty." So not necessarily we got it figured out, but we have figured out how difficult it's going to be to figure it out, says Bezos. And then Jamie Dimon of JP Morgan Chase, our people want transparency, knowledge, and control when it comes to managing their health care. So, Sam, starting with you, good idea, bad idea, or is this just three egos trying to make a headline?
I mean, I think, was it Jamie Dimon is exactly accurate when he says we figured out how difficult this is? Like
Bezos, yeah.
Bezos said that.
We're very wide-eyed about how hard this is going to be.
I mean, if it was an easy solution, this would never have been a topic. And so, I don't know. Have they even said they haven't said what their plan is?
But the effort was announced today, and it's in its early planning stages. So basically, they we're on a Slack thread and message each other like, "Hey, we should do something about healthcare." Cool, man. Got to go.
In my opinion, this is an ego play among three kind of egomaniacs in general. They were just all in Davos. I think Buffett went to Davos. Yeah. And they probably just said, you know what, it would be great is if we just created our own utopian healthcare company. And
it's like friends trying to start a bar together.
Yeah, exactly.
I want it to be known, I appreciate and respect their efforts, but right here on Young Bucks, we are the first podcast jointly committed with ourselves to solving the healthcare challenges faced by American employees. We're announcing that today. It's January 30th. By the time you're hearing this, it's going to be February 1st. But we are jointly committed to attacking the challenges of the healthcare system as it currently exists right here at Young Bucks. We're in. I think we've got as good of a shot as these three guys. We got one extra person.
We're short a little money though.
Anybody else got anything on healthcare?
No, but I just did want to go back and address my earlier point. We are still long the market. I mean, I'm not saying like dump everything and go to cash, dump everything and go short, but I just want to say, things are different this time this year than this time last year, and
stay disciplined.
You need to stay disciplined.
There you have it, bearish Ben, long the market.
Yeah. Now Ben is a bull. Let's get to what everybody's here for, football. One of our last opportunities to do this, our first opportunity to do it on season 2, Super Bowl. Patriots, Eagles. Patriots are a 4.5-point favorite. Going to start with you, Sam, because you are the front runner in terms of leading every bandwagon fan base that you can. I'm assuming you're taking the Patriots minus 4.5, but I don't want to speak for you.
Yeah, I got the Patriots. I mean, you've seen what Tom Brady can do. I don't know how you bet against Tom Brady. You just can't bench him in the fourth quarter,
I'm unfortunately also taking the Patriots.
Yeah, I think that's pretty easy
against a backup quarterback.
Actually, yeah. I mean, how do you bet against Bill Belichick in the Super Bowl?
Yeah.
So, I was actually born in Massachusetts, so I'm rooting for the Patriots this game.
Oh, hometown Ben.
But I'm actually taking the points in this, and here's why. Throughout all Tom Brady's Super Bowls, and you guys are smirking at this, but
I am.
But he's won one game by more than 4.5 points, and that was last year in overtime.
That's a good stat.
So, I mean, I'm taking the Eagles. The numbers on my side.
They've also never played a backup quarterback, so that's on his side, I feel.
Welcome to the bandwagon.
Some prop bets that I think really matter more than the game itself. National anthem. You can bet on how long it takes them to sing the national anthem. This is not what time the national anthem starts. There's some confusion on that. But 2 minutes even is the over-under. Traditionally, these things tend to go long. Pink is singing. I'm taking the over because I mean, it'd be un-American to not hug the spotlight out of a sense of patriotic duty. So I'm taking the over 2 minutes.
I'm gonna take over as well.
As a pop singer, I think it's an easy overcall. Like, there's no way she doesn't like drag out notes every.
Even Luke Bryan was over 2 minutes.
Yeah, this is an easy one.
I mean, I'm saying it's easy, but I'm saying the under.
Wow.
If you look back at the history, Alicia Keys wasn't marked an inflection point. I mean, you're talking 155 seconds, 2.5 minutes for Alicia Keys. Before that, no one was really over 2 minutes, and then she was kind of at the turning point. So I think there's a huge recency bias in the numbers. I'm taking the under.
All right. How many times is the name Carson Wentz going to be mentioned during the game? The over-under is 3.5. These ones always get me. They always like have these numbers, and you're like, oh, surely they'll talk about this more than they actually do. But it doesn't count like if they just talk about, Nick Foles, he's a backup. That's not mentioning Carson Wentz. So we got to hear his name. I'm actually taking the under 3.5, and this starts at kickoff. So like,
Is Tony Romo commentating this one?
I don't think so.
Okay.
But he would say like 1,000 times. So I'm taking the under here.
So I'm going to go over because very easily, I don't even know who the Eagles' backup quarterback is, but you could see him go to the sideline and Carson Wentz is saying something to him, and you can be like, man, look at the enthusiasm Wentz has. He's all behind his player. Wentz is always a good leader. And like, bam, you're at 2. They only got 2 more to go. So
Almost there.
I'm going with the over.
All right, there we go.
I'm going to go under. No reason, really. Just is what it is,
Do we get
Gambling,
halftime?
man.
If I get halftime, I'm taking over.
Sure.
Yeah, over.
Oh, that's easy if you include the halftime.
All right. Speaking of halftime, Justin Timberlake doing the halftime show. Will members of NSYNC perform with him? I think that's a no-brainer. Like, it doesn't even have to be the whole squad. It's just any of them come out.
Is that an actual prop bet that you
Yeah.
can bet on? Oh,
They're definitely
that's
coming out
easy.
there.
There's no way they blow an opportunity to
No,
do that.
they have to. Does anybody disagree with that? I mean, that's free money.
Lance Bass is going to be there. JC,
That's like, if you hear nothing else we say on season 2 of Young Bucks, bet on members of NSYNC
I'm
showing up.
totally
This is going to be a great cutout when I'm wrong, but this is the lock of the century. Members of NSYNC will perform with Justin Timberlake, guaranteed.
I don't know if it's that guaranteed.
Absolutely guaranteed.
I don't know.
It's an easier guarantee than Hillary winning the presidential election.
Yeah, this is a lock. I've never missed these.
I don't
All
know.
right, there we go.
Wait,
Young
what
Bucks.
does Ben say on that one?
I say yeah.
Nice, there we go.
What song did they sing?
Bye, bye, bye.
It's got to be bye, bye, bye.
It might be Dirty Pop.
It's going to be me.
Was Dirty Pop was in sync?
Yeah. Dirty Pop. All right. There we go. We're going to wrap it on that. Stay tuned. We got thoughts on the State of the Union as well as a call out from Ben. Y'all have a great day. Hey, everybody. We wanted to touch base real quickly on the State of the Union address, which President Donald J. Trump gave on Tuesday evening. Not going to get too political here. I think for the most part, he was relatively tame, if not long-winded. But we were pleased to see him not just outright insult too many people, no profanities, nothing like that. So it was a little bit more boring on Twitter maybe than you might have expected. But here were some high points from an economic or financial perspective from Donnie T's remarks. First things first, he talked about job creation. The strength of the economy in general was a big theme of not only what he's been saying in the rhetoric on Twitter and other places, but also in what he touched on in the State of the Union. And, if you're the president of the country and you've been the leader for a year and you've seen a strong economy, in a way you'd be crazy to not take credit for it. But I do think it's important to have some context with regards to economic strength. So understand a lot of these points I'm going to make. They're saying, yes, you're right, Donald Trump, you're right, but there's also an underlying story there. So one instance of that, he noted that the economy created 2.4 million jobs in 2016 since he took office in 2017 rather. But he also noted that they've made 200,000 new jobs specifically in manufacturing. So he's manufactured some manufacturing jobs, if you will. What's important to note here is the rate of job increases has actually slowed a little bit. Now, that's not to be an indictment of Donald Trump. It's kind of like losing weight. I don't know if you've ever tried to lose weight, but the first couple pounds come off pretty quickly. You get down 10 or 12 pounds, and all of a sudden that 13th pound is a little bit tougher than that first one was. So it's kind of like that. When unemployment starts getting lower and lower and lower, it's harder to create new jobs because there's only so much capacity in the economy. And when we talk about full economic employment, we don't actually mean an unemployment rate of 0.0%. That's not happening. It's never happening. So, inching from 4.5% or 4.4 where we are now down towards 4 is going to be really difficult. So, yeah, he's created new jobs. The economy's created new jobs under his leadership, but that rate has slowed a little bit. Manufacturing jobs in particular is an interesting note. That's really a political note. He's talked a lot about factories and international jobs coming back to the U.S. It's worth noting that manufacturing jobs are typically not very high-paying jobs. So when we talk about wage growth and things like that, which he touched on later, and we'll get to that in a moment, that's really not helping that number necessarily. So interesting data points there specifically on jobs. He did touch on African-American unemployment being at a record low. That's also true, but that number has been declining for quite some time. So again, we're hitting a low mark in a good way. Low unemployment is good, but it's also a trend that's been continuing. It's not like Donald Trump got elected and all of a sudden African Americans found jobs. That's not really how this works out. He also noted, quote, "After years of wage stagnation, we are finally seeing rising wages." That's, as Trump would say, fake news. Wages have actually been rising a little bit, really since around 2013, 2014. You did have a lull. You obviously had a little bit of a rebound after the financial crisis of 2008. So 2009, 2010, you saw a little bit of a spike, and then it seemed to kind of tread water for a little while. But really starting in the latter half of the Obama years, we really started to see some wage growth there. So there was wage growth. He's right, but to say that this started under his watch, that's fake news. He talked really quite passionately, I thought, about Obamacare and the removal of the individual mandate. Now, I don't have any kind of noisometer or anything like that where I could really measure the volume of the chamber, but it seemed like the loudest round of applause I heard, at least through my television screen, came when he talked about the removal of the individual mandate, which many view as a tax on people who do not have health insurance. And he noted that that individual mandate was hurting Americans making $50,000 or less. So it really appeals from a political perspective to a lot of people because there's a lot of people making that amount or less. A lot of people are sympathetic to people that are making that amount or less. And there's actually some truth to that statement. In total, the estimate is that about 4 to 5% of Americans had to pay that penalty, had to pay that mandate tax, so to speak, for not having insurance. And 60% of the people paying that penalty were making under $50K a year. So interesting point there, was well received obviously by Republicans. Democrats still kind of cling to Obamacare and aren't really all that excited to see anything change from that perspective, and that's, I guess, their prerogative. He did touch on drug pricing. Interesting point there. We kind of made fun of Jeff Bezos and Warren Buffett and these guys getting together and deciding, hey, Jamie Dimon, you can probably solve the healthcare crisis. We made fun of that in the panel, but now Trump's on board. Not that he has any more authority on this type of matter than those guys do, but it's a little bit interesting to hear it come from the top in terms of a government and have the President of the United States say, I'm targeting drug pricing. He actually said that last year, but he said it again this year, and he said, one of my greatest priorities is to reduce the price of prescription drugs. And he went on to note that many other countries have access to the exact same drugs for cheaper costs. So those are some of the economic points and the financial points he hit on. The market is up. Today's Wednesday when we're recording this. The market's up a little bit today. Certainly not on Trump news, more on the backs of Boeing and things like that. But the market has actually traditionally responded pretty positively after State of the Union addresses, regardless of who's giving them, whether it's a Republican, a Democrat, a first-term president, an incumbent, whatever it may be. The market tends to respond actually pretty promisingly there. So there you have it. Hopefully that's not too political for anybody, but it was interesting. If you want to get the other side of the coin and see what some other people were thinking, just look up the Nancy Pelosi gifts. That'll kind of give you some perspectives from the other side of the aisle. You don't even need to listen to the response from the Democratic Party to the State of the Union. Just look up her face. I think that'll do enough. We'll probably get that edited in here. Y'all have a great day.
Hey everybody, I'm Ben Nye. Welcome to this week's call-out segment. Today I'm going to be calling out CNBC for some misleading reporting that's happened over the past week and then especially over the past few months because I think they've been in error on multiple occasions. We actually called them out a few months ago, so I'd encourage you to check back on that. But essentially at that time they had prescribed that said that Amazon is going to be making a PBM announcement, Pharmacy Benefits Manager announcement, entering that business prior to Thanksgiving. And this happened in the beginning of October. And so CVS and a lot of those other competitors really got hit hard on that news, because you look at CNBC, you think it's a reputable source, and traders make decisions on that. And billions of dollars in market cap change hands because of reports like these. So the burden of responsibility really falls on CNBC in making sure that their sources are accurate and that they have a story that is reliable and potentially true. Now, stories will be wrong, sources can be wrong, but it is the burden of duty that a reporter gets the story right. And when you're making huge decisions, billion-dollar decisions on these type of stories, is very important. And unfortunately, this isn't the only time CNBC has made an error on this sort of stuff. Back right after Thanksgiving, there was a rumor that went around that was perpetuated by a guy by the name of Alex Sherman, who actually majored in journalism. I think he got his master's in journalism. Then he went back to Stern. He got his MBA. Apparently, he went to Harvard, graduated in 2004, majored in government. So kind of a strange career path for this character. But anyway, so he went to Bloomberg and was there kind of doing a lot of the production stuff on the media side, and then somehow got involved in the M&A space. He was then picked up by CNBC, and one of his first stories at the end of November was that Juniper was potentially the subject of an acquisition. This was immediately rebutted, saying this is fake news. And CNBC, they kind of then backtracked and said, well, it was because of the story and it moved the stock price, and then now they're not looking at a deal. I mean, give me a break. I mean, if someone's looking at a deal and doing due diligence on a deal, they're going to be talking about it, not based on a CNBC article. So that's totally false. And then this Sherman guy, this Alex Sherman guy, he comes up with another story earlier this week, right before the market closed at about 3:52 Eastern time on Monday afternoon, saying that Maxim Integrated Products is going to be bought out by, or is in talks to be bought out by, Renesas Electronics, a Japanese chip company. So the story was basically, Maxim could get bought out at a $20 billion valuation. Talks were still preliminary. No guarantee a deal gets done. So that's one thing. And he said multiple sources familiar with the matter. What ended up happening was Renesas actually came out and said, this is total fake news. We're not looking to buy Maxim at this time. We deny the reporting. This is poor reporting at best, and it's market manipulation at worst. And CNBC needs to hold these characters to account, and they need to get better at this, because as long as this fake news persists, there's just going to be continued distrust in the media, and you're ruining the market mechanism.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.